All right, we got about a minute and 40 seconds until we get things going. All right, 45 seconds until we get underway for this week. Thank you to those of you who are already tuned in, patiently waiting for us to get going. Looks like we got about 10 people in right now. Not too bad. We're 30 minutes late. Had a lot of traffic on the way home from dinner tonight, so I had to take a pretty long route. So that's why the stream's a little late. But it is gonna be all the same good stuff every single week. A little spoiler alert: we had a pretty good week last week, but excited to get into it and start talking about it. And I guess as of right now, we don't have the graphic up for the HT giveaway. I'll say we've got 10 people watching right now. If we get up to 30 viewers at any point tonight, we will activate the HT giveaway. You'll see that flash up on the screen right there, and then we could do it from there. But with only 10 on, I don't know if I want to do the giveaway quite yet, but there we go. The timer is run down to 0, so it is time to get things started. So once again, to those of you who tune in week after week with us, thank you for joining us for another weekly edition of our stock market scan. The way that we like to kick things off is recap what we did last week and then talk about what we've got for the upcoming week in the market. And we're going to have some pretty good discussion about what we're doing for the upcoming week in the market because, as you could see if I scroll down here a little bit, we don't have a ton of positions open as of right now. But let's quickly talk about last week because last week, was kind of the culmination of us trusting the process, sticking with it, making sure that we keep the positions we have, strategically add, make sure we don't get chased out of any bad positions, and we were starting to see a little bit of a bounce in our account. I mean, at the very worst of it, we were down a very significant amount of money in 2022 at one point, during this week. Since then, we've recovered about $15,000. We're still down 22K, which is a 12.62% loss on the year. But I think for those of you who've been following along with us, definitely understand the fact that what we have been holding has moved against us pretty severely. So the fact that we're only down 12.62% and have a chance to, quite frankly, break even in the coming month or so, I think is a great place to be, especially when you consider the volatility in the market, how up and down things have been. The stock market, if we go to the year-to-date summary, the market itself is down about, let's page over here, down 5.53% on the year. So obviously we're underperforming at this point. However, it's one of those things where we don't necessarily need the market to go up for us to make money. That's the beauty of our strategy, right? We know that if a firm finishes above 55, those are going to finish worthless. Roblox closed at, what did Roblox close at? 63.74 at the end of the day on Friday, meaning that these would be worth about $6 a piece. So just from those two right there, right, we'd recover $23,000 more and get back to even overall in the year. So while we are underperforming right now, just an example right there off those two trades of just no movement at all from the stock, would get us back to break even on the year. So not worried. All things considered, I think we're in a good position. I guess about as good of a position as we can be in when you think back to some of those weeks that we had in January where things were looking pretty grim for us for a little bit. But, we've lost money before. We've been in this situation. We didn't have a single losing week, or a losing month rather, in 2021. So we were a little bit spoiled, but, that does give us hope for the fact that, look, we're down $22,000 on the year right now. If you go back to 2021, let's get an idea. 3 weeks right here to make back, or 3 months rather, to make back 21K. 3 months right here to make 30K. A 3-month period right here made 23K. So the idea is that sticking to the strategy that we've laid out and kind of sticking to the plan that we have set forth, eventually with some patience, this is not an insurmountable deficit by any means. Are we going to make 100% this year like we made last year? I mean, probably not. That is going to be very tough to do, especially with the hole that we initially dug ourselves into. But I definitely think we could, turn back profitable on the year and, sooner rather than later. And most importantly, outperform the S&P 500, which is our ultimate goal with all of this, outperforming the market. But again, starting this thing off the way that we normally do with the recap from last week, Palantir was relatively flat on the week. I don't remember what it started off at, but we picked up some decent money on those, $1,160 on those 13.5 strike puts that we sold. And I think this is one instance where I think it'd be super interesting to highlight, why we did what we did. Because we were in a position at one point, and this is a trade that has run down and down and down and down to where, if we took assignment of the puts that we've been selling, our break-even price would be $19 a share. So, we're still doing some damage on that break-even price. We'll maybe get there eventually. Just important to stay patient. But what we did back at the end of January was, we had these 1,000 shares up here and another 1,000 shares up here. We kind of just got rid of all the shares. We started over. We said, we don't really want to fall into the sunk cost fallacy. So what would we be doing if we had no money? I mean, not no money, but no positions in our account at the beginning of the week. And the answer is that I think, honestly, we would have just been selling the 13.5 strike put. So I took a step back, said, hey, we've got a pretty decent loss up to this point. We got out of the shares at 13.8. Let's just start selling 13.5 strike puts and bit by bit by bit, try to make this money back as opposed to holding a really big share position, not really benefiting from any option premium and hoping for a bounce that may never come. So that's what we did. We got rid of the position. And what I want to illustrate here is why this was a good idea, why it's always important to be taking advantage of that option premium. Because as you can see right here, we got out of these shares for $13.80. We had 2,000 of them, right? And on Friday, Palantir closed at $12.94, which is lower than $13.80. So if we had just kept holding this position of 2,000 shares, we would have incurred a loss of about, $1 a share roughly. So we would have lost $2,000. However, in the meantime, in the 3 weeks that we've been, selling these 13.5 strike puts, assuming Palantir stays where it is, we'll have made $1,100. That's a pretty big difference right there, right? The difference between holding the shares as we previously had them, which would have resulted in a $2,000 loss, as opposed to doing what we're doing now, which has resulted in a $1,100 gain. So that's a pretty much, it's a $3,000 difference right there, which is very, very significant in my opinion. And one of those things where when you're trading in a super volatile market, one of the best things you can do is just hang in there week after week, selling as much premium as you can, taking advantage of options that offer the most extrinsic value possible is a great way to do that. And that is what we've been doing with Palantir. Obviously, still a pretty big residual loss left on this one, but it's nothing that I don't think we're going to be able to eventually crawl our way out of. It's just going to have to be little bit by bit by bit by bit at a time. We're not going to make 12 grand back in a week on this. But, I'm perfectly happy with that. When a firm and roadblocks, we talk about these a lot. As long as a firm stays above 55, and we had a nice little run on a firm week. Let's chart up really quickly. Come on, let me type. There we go. RM. I got a little here. And there you see, right? On Friday morning, it down to 56, but by the end of the day, it ran up to 64 before pulling back and closing at about 62.79. From a more macro view, if we zoom out on the chart, there's been a huge drop off in this stock, right? We jumped in on it when it was trading at 90-ish, I think, right around this, mid-80s is when we jumped in on this thing. And we traded it to stay above 55, which at the time, fantastic cushion. But as the way the market goes sometimes, as you can see from this little bubble right here, it actually bottomed out at 48.17. But again, the great part about our strategy is even when the stock moves against us that severely and that short of a period of time, we still have some recourse. We could hang in there, let that option premium, work to our advantage. And we rebounded from 48 back to 62, which again is above our max profit point of 55 a share. So perfectly happy to keep holding on to that one. And again, if a firm stays above 55, as it currently is, these will finish worthless in about 6-ish weeks, and we'll make another $9,000 on that trade. So we're perfectly happy to sit with that. And from this point forward, the 55 strike puts, as they're currently trading for 642, that basically means as long as a firm stays above 49-ish over the next 6-7 weeks, we won't lose any more money on this trade. And as we discussed on last week's stream, we could also effectively roll these another couple months out to lower that break-even price from 52-ish, probably below 50, and just keep rolling with the punches on that. But one big thing for a firm is that this week, if you look over here, They present earnings on February the 10th, which is going to be Thursday. There you go, Thursday after market, I think. Yeah, so Thursday afternoon. And that really is going to kind of seal the fate for us on this trade, especially if we're hanging out in this low 60s level for a firm headed into earnings. And there's probably going to be a pretty big MMM right here. Yeah, plus or minus $12 move right here priced into the options for the upcoming week. So people are definitely expecting a big move from earnings. But one of those things where, hey, if a firm has good earnings, shoots up $12, and this thing's at 75 with earnings behind it, we're probably going to be able to close these things out for maybe less than $1. And that is going to be something I'd be happy to do because, there'd be $8,000 of profit in a week. So big time event for a firm right there. We could get a decent amount of profit if earnings go well, but even if they don't go well, we have a little bit of cushion still on the downside, down to 55 and even down to 49 to, not lose any more money. So I'm happy to keep holding out of that one. Roblox was one that we actually got out of and then back into during the week, which was kind of an interesting trade. And to address Jules' question, and no, we do not have the webcam yet. I will have to order it at some point soon because it's coming. I'm very ready for it. We can now officially use the webcam on the streams. You'll have, my face sitting, I don't know, maybe we'll go bottom left for my face to be sitting here staring at you just so, I can have someone maybe to look at while I'm saying some of these things while I sit in my bedroom alone on Sunday nights. But it is coming. Do not worry about that. I'll have to put the order in. And to those of you who have also won an HT giveaway, those tumblers have been received, and we are going to be shipping those out this week as well. So a couple things on the to-do list, but definitely stay on me if I don't hold up my part of that bargain right there. Next trade we were going to talk about was going to be Roblox from the past week. We jumped out for $14.85 and then re-entered for $14.75, so we lost about like $100 in that scramble, but I think it was worth it. The question is, why did we exit and then go back in? The answer is because last Thursday afternoon, Amazon was reporting earnings. The market was shaky, and I think if Amazon had a big miss and went down significantly, it really would have brought down the overall market. So we wanted to cut down our risk a little bit right here, and that's exactly what we accomplished. But by the end of the week, we got back into the trade for roughly about what we closed it out for. So no harm, no foul right there. We're happy to keep riding Roblox, another week as we move towards that April expiry with our 70 strike puts. And this is one where below that price target, right? If we pull up that Roblox chart, finished to 63.75. Similarly to Affirm, it has been much lower, but also similarly to Affirm, there's been a very, very big drop off from the peak of 141.60 back in just November of last year. And all things considered, right, even with the IPO price back in the 70s, where it traded and bounced between 70 and 90 for a good 8 or 9 months last year, we have a situation where our break-even price is roughly 66-ish, so it's right around there. They have earnings coming up, not this upcoming week, but the week after that, so that'll be something for us to keep an eye on as far as upcoming events. But again, another area where our strategy is so valuable, because even though we faced a really, really nasty slide, I mean, this thing went from 105 down to 53 in less than a month, which is a huge, huge, huge drop. And people talk so much about, how big is this quote-unquote dip in the market, because the S&P 500 is only down 5% on the year, so it's not really feeling it too heavily, because, those stocks like Amazon, like Apple are kind of propping it up still a little bit. Those dominoes have not quite fallen, not that they will, but I think the general health of the overall stock market is really not as great as the larger indices would suggest. When you've got price action like this going from 100 to 53 in the course of a month, that's a 50% drop on a pretty large cap stock for Roblox. But again, lots of banks have readjusted their price targets, redone the analyses, and issued some price targets around 90, around 100. So even at the end of the day, if we do have to roll this position and move that break-even price down to the low 60s, I'm perfectly happy to keep holding something when we look at a chart like this, seeing some of the analyst price targets. And I think if I pull up the live news, let's see. There we go. The price target was cut, but it was cut down to $110. So, the bank is basically saying, we think this stock is worth buying, that it's going to rebound to this level. So the fact that we're in here with the mid-60s-ish break-even price, dude, no harm, no foul. We are going to be okay. It is definitely scary, though, because we had a pretty big loss on paper, right? If you scroll back to some of these previous weeks, Roblox was bleeding out premium for us. This week that we lost, 23 grand in the market. Roblox and Affirm were a couple of the biggest offenders right there. And it's definitely scary on paper, but at the end of the day, we need to remind ourselves that, our break-even price on Affirm is going to be mid-60s, or excuse me, our break-even price on Roblox right here, 66.2. So as long as it stays above that number, we are going to be okay no matter how bad the price action gets, no matter how volatile options get and how much the premium spikes up. All of the losses as of right now for Roblox are on paper. So just make sure you don't have so big a position that you get margin called out of it. But as long as you can afford to keep holding this, just like we talked about last week, you could roll the position for probably a decent bit. And if we look at, if we go 2 months out here and look at the extrinsic value on these things, this is going to give us an idea of what kind of credit we could roll for. But right around the money, right, you'll see, $9-ish, $8-ish of extrinsic value, which means we theoretically, if we wanted to roll these April puts when we get to April, would be able to roll those for a roughly $8-ish credit the way things currently stand. So with that in mind, that would take our break-even price heading into the summer below 60 even. And again, looking back at that Roblox chart, 60 is a perfectly acceptable place to be on a stock that has this kind of trading history since it's been in play. So that's kind of the spiel on Roblox and Affirm, two of the larger positions we've been on. Perfectly fine with that. And speaking of these larger, more margin-driven positions, we also added one Facebook 200 strike put after kind of the disaster that they had when they reported earnings this past week that initially saw a pretty big corresponding drop in the overall market. Let's pull up this chart right here really quickly, and I'm going to take a sip of water before I keep going. There we go. And as you can see from the enormous red candle on the 180-day chart, really kind of an unprecedented drop. I think I remember reading that this drop from Facebook was, from a market cap perspective, the most value that has ever been wiped off of a stock in one day. So, what do? We take a look at the RSI. The RSI is, in the absolute gutter right now at 27. We know anything below 50 is technically oversold. Anything under 30 is, severely oversold. So from an RSI perspective, we could potentially expect some sort of short-term relief here. And what we didn't really get was a huge drop-off in implied volatility, right? Normally when you see these little icons right here that represents previous earnings, and you'll see earnings, and after earnings, the IV drops off. You'll see earnings, after earnings, IV drops off. You'll see earnings here, but the drop was so severe, in fact, that IV is still relatively elevated. And there's still a pretty big drop remaining to get back to more typical implied volatility levels. And what do we know when implied volatility is inflated like this? We know that it inflates option premiums, which is great for us who sell options. So what we did to take advantage of that was we sold an April expiry 200 strike put. $19,550 fully cash secure, but for those of you who are using margin, it's only a 10% margin requirement. So this position only uses just a hair under $2,000 of buying power. And with max profit of $450, this is a roughly 25% return on our capital in about 2.5 months, which is a fantastic number. And we're going to get that return so long as Facebook stays above this number right here, this 200 number that I could highlight with this red line. Let's remove these other red lines really quickly so we could see a little bit more clearly. Remove drawing. And looking at the past 180 days, it hasn't traded anywhere near $200 a share. Let's back up to the 1-year chart. You have to zoom out on the y-axis to get to our $200 price mark right here. To the 3-year chart, and there you go. You finally, find a date and time where this thing traded below $200 a share, and that was back in April of 2020 in the back end of the COVID crash. Now it got down to 137 at the very bottom, and I'd be lying if I said there wasn't further potential downside below 200. But, as we've seen so often in the market, it's never a straight line to the bottom, especially for a large cap stock like Facebook. I think I quite honestly would be surprised if this thing made it significantly further below 200 in the next couple of months between now and our April strike date. But, a couple of takeaways that we had from our larger trades like Affirm and Roblox is off the bat, I really wish we would have started off smaller. And I'm taking that lesson and I'm applying that to what we did with the Facebook 200 strike put right here, right? You can see these Roblox and Affirm trades are much, much, much larger. However, with Facebook, if it does keep moving past 200, on the downside, and this premium really starts shooting up, I want to leave myself some position and some flexibility to scale further into this trade so that I could raise my average credit, right? So we know that a 200 strike put sold for 4.5 gives us a 195.5 break-even price. If Facebook has another big red candle in the next month or so, I want to potentially double my position, increase the average credit, and lower that break-even price as we head towards that April expiry. But again, another very high percentage trade. It would take another pretty big non-earnings move to get below 200 a share by that April expiry date. So I personally don't believe it's going to happen, but that's kind of the name of the game with these option selling strategies that we're using. We want high percentage outcome trades. And even in that low percentage potential outcome where it moves against us, the only thing that happens is we just end up with the stock at a very favorable basis. So we would just end up with Facebook stock at 196.50, which historically speaking is a fantastic price to own what is a decent company. They're making a really solid amount of money. So that is the idea right there. We wanted to leave ourselves positioned to potentially further scale in, but taking some of the lessons that we learned from Affirm and Roblox to parlay that into this type of a trade, starting smaller, but picked a solid stock at a solid price point where we have some indicators like RSI, which are in the absolute gutter, and implied volatility is historically a little bit higher than it normally is, right? 91% of days out of the last year were lower than the current implied volatility, so we can count on a little bit of a pullback there. And the one other little thing here that I think is very important to highlight is the time frame that we chose for this Facebook 200 strike put. That April expiry, if we go to the tab, 67 days away, and we know from a chart that I had in Discord, I don't know if I'll be able to pull it up right now, but options that are further out of the money, so 200 being decently far out of the money here for us, but those options that are further out of the money tend to lose a little bit more, and theta decay actually accelerates around the 45 to 60 day window. So this April expiry right here puts us right at that front end of the window where further out of the money options begin to start to expire a little bit more rapidly. So that's kind of the idea behind that April expiry as well. So we have a lot of different factors for us going here, right? Facebook implied volatility is elevated. Facebook RSI is below 30. We have a very solid strike price. Thanks to margin, we actually get a 23.5% return on this thing, and that's a pretty phenomenal return on capital for 2 months. And then the last point is that we have this right at the front end of that window where theta decay is a little bit accelerated for options that are sold further out of the money. Draftkings. Let's talk about Draftkings. We finally had some good news on Draftkings, whereas in previous weeks, I feel like this thing has just been slowly moving against us. And, it's definitely been a little bit of starting to turn into a bit of a marathon here for us as we started this trade in the back end of November when it was trading at $36 a share. But this has been such a good example of how we can continuously chip away at our break-even price. And even though a couple weeks ago, let me pull up the chart to kind of illustrate what's been going on here. But even though a couple of weeks ago, right, when Draftkings was at a low of 1741, break-even price was like 26, that's a trade where you might say, oh my gosh, I have a 26 break-even price. The stock is at 1741. I'm like $10 away. This kind of seems a little bit insurmountable. But that's where, even though your break-even's at 26, just keep selling calls where you're able to get some premium. You're able to keep chipping away gradually at that break-even price, quote-unquote, trust the process, to quote Joel Embiid, and just keep lowering your break-even price, and you'll, eventually one day the clouds will part, the sun will come out, and you will find yourself within striking distance of breaking even on a trade. And, when Draftkings was at like $17 a share, we had a pretty significant loss going on this position, but now we're back in, back kind of in the driver's seat, so to speak. And this thing goes back up to 23.5 this upcoming week. We're only going to be down $2,600 on a trade that we were down $15K on at the bottom just a couple of weeks ago. So that's a good example of, one, sticking to the process, kind of following the process that we lay out for these trades, and two, just how these things can, just as quickly as they moved against you, how quickly they could turn right back around and get you into a potentially winning position. So that's the idea right there. And one other quick point, we always talk about what to do with your cash secured puts when the stock moves against you, and we always want to roll down and out for a credit if we can. For Draftkings, when you're selling covered calls, you have shares and the stock is moving back up. What do you do if your strike price is breached? And the answer is, where with cash secured puts, we want to roll down and out for a credit. With covered calls, we want to roll up and out for a credit as well, because rolling up increases the amount of profit that we can make on our shares, because we know when we sell covered calls, we're capping our share gains at that strike price. And then we want to roll out for a credit because it means that our potential max profit on the premium that we're receiving from these covered calls also increases. And, in doing that, you lower that break-even price even further. So while we walked into the year 2022 with the 28.42 break-even price, we're a month into 2022 and we're now at a 24.84 break-even price. And that's the idea, right? Just keep chipping away, whether it's 40, 50 cents a week. That really adds up over time. And as we mentioned a little bit earlier, while it has definitely seemed like a straight line to the bottom for Draftkings, where it went from $63 a share back in September of last year down to $17.41 in just the end of January, a huge drop on the stock, which furthers the point that, a lot of stocks in the market are really not doing well. This is a dot-com crash type drop right here, as this thing had, 75% of its value shaved off in about 2 or 3 months. But the idea is, it typically isn't a straight line to the bottom, but things will come back up. They'll come back down. I mean, I'm not guaranteeing that this is going to shoot back up to 30 or anything like that, but I definitely would like to play it as such and keep walking this strike price up week after week, maybe a buck or two. And we could get ourselves in a position where if we keep rolling this up and it never actually breaches it, and we could walk it up maybe $1 or $2 at a time and play this thing back up to 30 by the end of February, now we're making $10,000 on a trade where over the life of the trade, the stock has dropped 16.67% on us, and that is the value of our strategy that we're running. So again, 24.84 is our new break-even price as we head into the upcoming week. Plan is just to keep working with this. Like Mahir's saying in the YouTube chat, the Super Bowl has to give it that short-term bump, and I really am hoping so. I feel like the last time that I kind of tried to play a little bit more aggressive of a trade here was back at the mid-January when they legalized those mobile sports betting apps in New York, and I'm like, all right, this is going to be fantastic for DraftKings, and it did not really work out that way. We had those 28 strike puts, which were a little bit aggressive, but they ended up not working out too well for us. So that kind of a little bit of an egg on our face there, so to speak. But more potential bullish news with the Super Bowl coming up this week. So I'm hoping that line of the news cycle can help pull that stock back up for us. So that's DraftKings, and I was between a 23 and a 23.5, and following that line of logic about the Super Bowl being this upcoming Sunday, that is why I went quote unquote slightly a little bit more aggressive at that 23.5 strike to give myself a little bit more upside for the upcoming week. And again, if we want to talk about this on a weekly profit and loss perspective, if DraftKings runs back up to 23.5, we're going to be taking home $3,300 of that and $900 from the premium on our covered calls, no matter what. So that'd be a $4,200 weekly profit just off of those. And again, that chips away at that big red number that we had sitting up there. So if something like that happens, just a little bit of a rebound at 23.5, if a firm has good earnings and stays above 55, all of a sudden this is turning from red to green very quickly. There was a lot that went against us in a very short time to put us into the big hole that we were in to start off 2022. But the good news is it doesn't take much from here on out to get us back out of that hole, and we're just going to keep sticking with it on a week-to-week basis, hoping that one day, we'll get where we need to be. We had a question from S. Grabner in the Twitch chat, why not sell covered strangles? And the answer just has to do with position sizing, right? We know with the HT wheel that we typically want to start with about half of the total position that we're comfortable taking on. And that's what we did with 10 of these 33 strike puts off the bat, which, 10 cash secured puts represents 1,000 shares. So about 1,000 shares is the, so to speak, half of the comfortable position size that we initially had off of the bat. Now, we did start to do some covered strangles, and so covered strangles are always a great idea if premium is high, you've had something move against you that's really primed for a bounce, and you're okay with slightly increasing your position. They very effectively decrease your break-even price, and we had a few in here, right? We sold a couple extra cash secured puts a few different weeks, right? In January 7th, that expiry, we kind of doubled up with some 25 puts as well. The 14th, we doubled up as well to make a little bit of a strangle right there. But the reason we're not doing covered strangles right now and just sticking with cash secured puts is because we now, when we had a $1,000 or 1,000 share initial size, we knew that we were comfortable with a max of maybe 2,000 shares, but now we have those 2,000 shares. So a covered strangle at this point would increase our position past the point of what we're comfortable with. And, from our account size perspective, put us at a little bit too much risk, right? As we've demonstrated week after week after week after week here, we can keep lowering that break-even price, moving the goalposts, so to speak, and eventually getting ourselves to a position where our break-even price is going to be lower than the stock price. But we also, if we did continue to do those covered strangles, that would be very risky, as we'd be, 200% of what we're fully comfortable with, and that's just not, from a portfolio diversity perspective, not what I'm trying to go for. But if you are someone who is just recently getting into DraftKings and you've started selling puts in this low 20, the low 20s level, and you are not at that full position size yet, covered strangles are a fantastic idea to help manage that break-even price, and definitely part of what we outline in the HT wheel strategy. So back to that weekly tracker. What else are we going to talk about here? We've got Fubo again. We can quickly talk about Fubo because that's another trade that we have for the upcoming week. There you have it, right? Another one where we started this thing at 17.5. If we pull the chart up for Fubo, another stock that has just absolutely crushed over the past, right? This is November right here. So if we go back to this 180-day chart, Fubo has been absolutely slaughtered in the past few months. And, we tried to take advantage of that by being patient. We didn't get in the 30s. We got in at 17.5. But even after 17.5, this thing still has just kind of slid off the face of the earth all the way down to 8.6 at the very bottom, which is a huge drop off. But again, the hope is that, Fubo, decent name. They've got streaming rights to the World Cup that's coming up this summer. I think they're going to get a lot of buzz around that. So we're happy to be in at this ish level right here. And I think this red line 1286 is where our break-even price used to be. There you go. But now our break-even price is down to 1260. So we can even move that red line. If we remove that drawing, move it down to 1260. There you go. That is now our break-even price. And again, if you go back to the chart, this red line, not a bad place to own the stock at, historically speaking, with where this thing has been trading over the past calendar year. But obviously with the stock at 10.1, it's not the greatest position right now from a profit and loss perspective, that's for sure. But again, same logic as DraftKings, week after week, even if it's only 20 cents at a time. We're going to keep taking this thing down and down and down and down. And again, another trade where our full position size that we were comfortable with was going to be 2,000 shares. We're up to that with these 2,000 shares, this plus this right here. So we're not going to use more coverage strangles here, and we're not going to further try to increase that position size. Although there is decent premium on the put side. Don't get me wrong here, right? If you look at the upcoming week for February 11th, you'll see you could sell a 9.5 strike put and knock 30 cents off that break-even price. But as of right now, we're at the full position size. We're sticking strictly with covered calls going forward from here. But again, moral of the story, take a step back. We started playing this thing at the end of December. It is now, back when it was trading at 17.5, and since then it's dropped to 10.1. We are playing a stock that has dropped 42% on us in about 6 weeks, which is an insane drop over a short period of time. So often we get the question, what happens in the strategy if there's a stock market crash or something like this? And I think with these stocks that we've been holding, things like Palantir, which has dropped 47% on us, Draftkings, which has dropped 40% on us, Fubo, which has dropped 42% on us, these three stocks right here and how large they've been in our portfolio, this essentially is the equivalent of what a stock market crash would look like for us, to be quite honest. So, look at Roblox right here, dropped 32% on us. Like what you're seeing happen to us in January so far, and that big number, that big red number, this is the equivalent of what would happen to our account if the market crashed. But again, we stick with these trades, and even though these things are still down about 40-ish% on us, we, as we have outlined throughout the stream, have a path back to profitability. So this type of strategy that we're running handles these market crashes, so to speak, very well. And we've got me here in the YouTube chat saying, let's check out some long-dated Fubo puts, right? And we're always big fans of those long-dated puts. If we want to look at the window that we like to look at, it'd be this April expiry, right? Because we know 45 to 60 days from expiry on those out-of-the-money puts is when theta decay really starts to kick up a little bit. So this April expiry would be it. And let's see, these longer-term puts really all kind of depend on the type of margin help you're getting right here. If we look at like a 7 strike or something, you'll see, max loss is 6,500, but it only requires 2,000 of buying power. So you get about 33-ish%. So you can basically multiply any of these numbers on the ROR column by 3 to get your ROC, since the margin requirement is about a third. But with that in mind, where would you potentially want to sell a long-dated cash secured put? And we can see that the low right here is 874. If we back out to the 3-year chart, we've got another low over here at about 812. But in the last 3 years, and really it's only the last 2-ish years because this thing IPO'd back in April of 2020, it has never traded below 8. And they had some good news come out, a few weeks ago that they guided their subscriber expectations upwards, meaning that they expect their subscriber numbers to be very, very nice for the upcoming earnings that they're going to be reporting. Those earnings come out February 23rd. So this is the last week of option selling for us before we get some of that increased, earnings premiums, which look pretty nice. We could go all the way out to, this is going to be earnings week. There we go. Where we could, historically, like for this upcoming week, we've been selling the 11s for 24 cents, but you could get 24 cents all the way, in the 14-ish area for earnings. So definitely looking forward to those coming up soon, because that is one event that could definitely turn this into a profitable trade. But back to the topic at hand, which is what price would you want to sell these cash secured puts at? And honestly, I don't hate the idea of an 8 strike because, again, we know that an 8 strike is solid because it's never traded below 8. And that's a pretty solid place to have a max profit point. However, what we also know is that it's not just about that 8 price level, because that's just your max profit point. When you're selling an 8 strike put and you get 80 cents of premium for it, your break-even price is 720, which looks even better, obviously, than 8, and especially when you look at it in that 3-year chart perspective. I mean, RSI, again, on the 3-year is in the gutter. It's not often that you see RSI get into the blue on such a long-term chart like this, so that's definitely a great entry opportunity for something like that. And I think implied volatility, spiked back a couple weeks ago, but again, still relatively elevated as opposed to where it was trading in the back end of 2021. But I like that 8 level, and if you really want to get comfortable and drop down to a 7 or a 6 or a 5, those aren't bad options either, right? Because we'll remember that with the margin requirement, we are going to multiply these RORs by 3. So if you wanted to get like ultra conservative and sell a ton of these 6 strike puts at the mid for 26 cents, that's a $260 return on about $1,000 of and that's the other thing too about these margin privileges. The further out of the money you go, the less buying power it takes up. But again, if the stock drops, the requirement goes up, so you always want to be cognizant of that cash secured max loss amount as well. But again, that would be a $260 return on $955 of buying power for a 6 strike on Fubo. I mean, that is phenomenal, right? That right there is a greater than 26% return on capital in 2 months on a very, very high percentage trade. And, putting some of these numbers out here, looking at the margin situation, it starts to become pretty easy to see. Well, we started to target a few more of these so we could have some of these in the back of our portfolio to help us out on a week-to-week basis. We've also got me here in the YouTube chat saying Fubo price to sales is hilariously low for their current revenue growth. And I mean, I think I love that valuation. If you factor that into their subscriber growth that they're claiming they're going to have, I think one of these longer dated April expiries is kind of a no-brainer. If you want to get crazy, go out to May or something like that, I guess you can get a little bit more premium. You can get a 5 strike for like 30 cents, which is, I mean, that right there, look at this. $300 max profit off $500 in buying power, just so long as Fubo remains above 5 by May. And, that is a 60% return on your capital. So these are the types of trades that when you look at them, it's like, okay, there's definitely some value here. And one of those things where if Fubo runs away, you don't necessarily need to take these trades until expiry, right? If Fubo runs up to 15 next week, you can almost be guaranteed that you'll probably hit half of this return as that premium declines. And if you hit half of a 60% ROC, what does that mean? That means you're making 30% ROC in, a week or two. And that is never, never, never a bad number to have. So big fan, especially in environments like this where implied volatility is a little bit higher, where the VIX is getting a little bit higher, the market's a little bit shaky. That is the time to strike for some of these longer dated puts because, one, you're going to get more premium on them when the VIX is high, when volatility in the overall market is high. And 2, look at these cushions we've got here, right? A 5 strike put is a greater than 50% cushion on the current Fubo price of $10.10. So not only are you getting a really good value proposition from an ROC perspective, you're also giving yourself a really, really big cushion to protect yourself if the market makes a significant move further down. And that is why I'm a big fan of some of these longer dated trades in the back end of our portfolio to give us a little bit of, variety in what we're trading, a little bit of a backstop against some of the weekly trades, and above all else, a little some lower stress, bigger cushion positions. So, Fubo looks really, really good for something like that. We are in it because we're in it, and this is kind of the trade that we've taken on, and we're kind of sticking with it. But if this were to be called away from me tomorrow, and I had the chance to break even on this and wanted to way back into Fubo, these April Mays right here, these look very, very, very interesting from an investment perspective. So that's the spiel on Fubo, right? 1260 break even price. We are not terribly worried about that because look, we knocked off 22 cents on it this week. That's 211. Next week is going to be 218, so we'll be able to knock another 20-ish cents off, presumably. That'll get us down to 12.4. And then we arrive to earnings week where, kind of the world is our oyster, right? If we have a 12.4 break even headed into earnings week, we could sell a 12 strike call for a decent amount of premium and potentially be in a situation where we have finally accomplished our goal of selling a covered call above our break even price in spite of the fact that the stock has dropped 42% on us. And when this thing was back down at 8.1, we found ourselves in a situation where the stock had dropped 53% on us. So these are some insane drops. But with the strategy that we're putting into play, this HT wheel strategy, we have been able to weather the storm, so to speak. And a lot of these trades have break-even prices that are starting to be within striking distance. And if you could find yourself using a strategy where if a stock drops 40% on you and 50% maybe at the peak, and you have broken even on that, on the life of the trade, that is a long-term winning strategy. And that is exactly what we're going to be sticking to on a week-to-week basis here. I guess, what else do we want to talk about here for the past week? Not a ton to talk about. BKKT, we are kind of done with that one. There wasn't enough premium on the 4-strike puts, so we're leaving that one alone. Beyond had some really, really nice premiums this week. SoFi, Arrival is a good example of an IV reversion type trade, and these have a very, very high winning percentage for us historically. So what does that mean exactly? There are a few different criteria that we like to talk about for an IV reversion type. The first of which is a big spike in the stock, which in turn causes a big spike in implied volatility. So if we back up to the 10-day chart right here, you're going to see this really, really big stock and really, really big spike, And strangely enough, I think if we back out a little bit further, there you go. Implied volatility really started spiking up around this 4-ish level. And then you see this little green candle. I mean, it looks so small because of how much this stock has dropped in the past, 180 days. But again, we see this big green spike. And, intraday, you can't really see a ton of it right here. But there was a little bit of a jump up in implied volatility. And, so these are the types of things that we like to see. Spikes in stock that are caused by good news. And I think if you look at the Newswire, maybe 5-ish days ago, something was going on. I forgot exactly what the... Let's see. I think maybe they had good earnings or something like that. But there was good news, I guess, circling back to the point I was trying to make. We like spikes generated by good news because the idea is, look, if you have a stock that's trading at $3 a share and there's good news for the company, theoretically, it should be worth more than $3 a share. But when the stock spikes up like this and implied volatility is super high, the great part of that is that increase in implied volatility keeps option premium high. So if we at a high level think that a stock that was trading at 3 had good news and is worth more than 3, then surely selling a 3-strike put is a no-brainer. And we love these spikes in implied volatility because it puts premium in these 3-strike puts that are decently far out of the money. And even if it falls back down, 290 is a great place to have the stock at, historically speaking, right? I mean, back at the beginning of January, this thing was up at like 7 or 8 a share. So having it at 290 wouldn't be the end of the world. And these typically turn out to be very, very high percentage trades. Like I think if we look back to the 2021 strategy summary and we've got IV reversion, 36 wins and 2 losses on those IV reversion trades for a 94.7% win rate. And, they're a little bit tougher to find. They don't come up every single day, and we're working on throwing together. I guess we do kind of have a little bit of a bot in our Discord server. Let me pull this onto the screen so I can give some context to what I'm talking about. But, they're a little bit harder to find because you kind of got to be on your toes. You got to be ready for when those spikes in the stock price occur and spikes in implied volatility occur. So what's a great way to be ready for that is we've actually created a bot in our Discord server, which is going to alert you to when trades like this potentially come up. And there you go. There's the alert. ARVL was added to IV reversion stocks. And just from that little alert, we made $200. So I think, one, if you're thinking about joining our Discord server, HT Premium, you can go to hourglass-trader.com and sign up for that. You'll get access to all the premium channels in our Discord server, and one of which is these option scanner alerts, which we are definitely planning on building out a little bit more. I think part of the value proposition of what we offer as a service, we are trying to have a little bit more automated trade discovery and trade ideas going on in here, and this is kind of the first step in that. But again, HT Premium, 1 week free, or it's $25 a month. And I think for a trade where, being a member of the Discord server and having access to these alerts, just this alert right here made us $200. So, I think there is some decent ROI on the HT Premium subscription. But that will be the last that I talk about at hourglass-trader.com if you want to sign up. Moving further down the list, PayPal was another, post. And this is, I think, a really good one to talk about because you could look at the profit. You opened up a trade on PayPal. You sold a 120 strike put on PayPal. Where did it go? Okay, it's right here. You sold a 120 strike put on PayPal. Why did you jump out for a $63 profit when PayPal was still above $120 at the end of the week? And after I take a sip of this water, I'm going to answer that question. Okay. So the answer is because when we jumped into PayPal, it was off this big red candle. We are a big fan of these post-earnings big red candles on stronger names, things like PayPal, because typically, can it go lower? Absolutely, right? And it went from 132 down to 121 at the lowest point. So it could definitely go lower, but historically speaking, you're able to get some decent premium on these things, right? We sold these for $1.68, which we know is greater than a 1% ROR. That's the number that we like to target. If we go back to the 180-day chart, even if we were assigned, we'd be assigned at a $119 share price, which is, kind of hilarious, right? This is where we would own the stock at. And, we had done analysis on this thing back at 250. So getting it for around like $118.50 a share is one hell of a deal. Go a year back, and this thing, was hanging out in the $200 to $300 range for the better part of the past year. Go back to the 3-year chart, and there you go. That is where we start to see PayPal drop back down to this level. It hadn't traded similarly to Facebook. It hadn't traded down at these levels since 2020 at the back end of that little COVID rebound. And then further, you could have PayPal at the price it was trading at in July of 2019. So I figured, 120 was a fantastic area to sell that at. And with the, relative spike in implied volatility from this big red candle that we see right here post earnings, I was comfortable with doing that. And we were able to get a decent amount of premium. However, let's take a look at how this trade unfolded, right? We entered right around here at 135, I think, after the first initial red candle on the morning of February the 2nd. So in plain English, what happened during the duration of this trade? And what happened is we entered at 135, and by the end of the week, it was trading at like 124. So the stock went down on a bullish position, and we took a look at the trade and said, hey, we had a bullish position. The stock went down, but look, we were actually making money. So I think high level, we always talk about trying to win every single trade, right? Because if you don't lose, you win, obviously. So if we have a trade where we take a step back and in plain English, the trade moved against us, still had another week to go, yet still we were actually making money, I think you're greedy not to take that. And even though it's only $63 and kind of pales in comparison to some of the other profits that we made on trades during the week, all that matters is the fact that it is a winner as far as I'm concerned, right? Because if we took this thing in the next week and it bounces back up to like 5 or something like that, I've already pasted values in here, so I won't update. We could have found ourselves going from a $63 gain to a loss of maybe $1,000 or something like that. And those are the types of situations that we like to avoid. So that is why we closed out PayPal at the back end of last week. We said, let's get our buying power back. Let's, reload the cannons, and then Monday morning we'll come in with a solid game plan and add something at that point in time. And then the only other thing I really want to talk about from last week were these Spotify and Snapchat earnings trades, right? Spotify, we were playing these strictly for earnings trade. This was a pre-earnings trade, right? We saw Spotify trading at 190. We said, hey, we could sell a 150 strike put, and we could still get greater than 1% it wasn't greater than 1% ROR. It was what? We sold it for $1.55. Oh, it was greater than 1% ROR. So we can get greater than 1% ROR for an earnings trade on something that is hilariously far out of the money, right? When a stock's trading at 190 and you can get premium at 150, that is a fantastic value proposition. So that's exactly what we did. And from a little bit further of a TA perspective here, this thing had been similarly to PayPal, right? It was one of these growth type stocks which had been running up a ton, has fallen back down, but objectively a decent entry, especially if we back up on a macro view, look at that 3-year chart right there. And now the next question is, how do we pick 150, right? The stock's trading at, or was trading at about 190. This is basically the chart we were looking at before earnings and when it fell off a cliff right there. But how do we choose 150 as a strike? And again, if you have that 1-year chart up, you're not really going to be able to find too much support. The idea is we want to find an area where we think is going to quote unquote catch the stock that we'd be safe to sell a strike at. And you could find that by looking for support in the past year or so, or the last time it traded at that level. And in this case, we can see the 1-year chart right in front of us. It hadn't traded at that 150 level since, if we have to go back to the 3-year chart, and the last time it traded at 150 was back in May of 2020. And again, how do we try to identify these areas of support and resistance? Right here, you can see back between, let's see, it looks like June and August of 2019. It was trying to break through this 150 level and never came back down. It was resistance. And then again in December through about, March of 2020, it was trying to get through this 150 level, couldn't get it, came back down. So these are two levels of what we call quote unquote resistance. And when resistance is broken, that turns back into support. So we can see 150 was rejected twice here. So the idea is that if this stock really decided to fall off the face of the earth, it was going to stop at 150. So that's why we sold the 150 strikes. And the great part about this is, we kind of hit it dead on the number, right? It was super scary after earnings when Spotify had this huge 20% drop. Results weren't as great as everyone wanted them, and it was trading at 150. But, we rely on the numbers, right? We rely on the research and the preparation that we put into that trade, and it was almost like a self-fulfilling prophecy, right? It was pretty funny where, at about 4:20, 4:25 p.m., we're like, this doesn't look great because if this runs too much further below 150, we might find ourselves in a little bit of hot water. But it bounced right off of the 150 level as we predicted. And it's not luck, it's not us looking back in hindsight and saying, oh, this was so easy. This is just the process that we put into these trades and why there's so much opportunity around earnings trades, because it's, not the easiest thing in the world to predict, but there are some decent ways to have some solid educated guesses about what levels stocks are going to bounce off of. And again, this isn't me just kind of saying something really quickly. You could go take a peek at our Discord server because we talk about the earnings trades in there. And we talk about what we did with Spotify a little bit further up here, respecting that 150 level, and we laid it out. Here we go. The market maker move was plus minus 25, put the low end of the range at 167. 111 and 155 looks like the range it used to trade in. And again, these are all time-stamped things from right before earnings. This is not just us randomly throwing this out here. We talked this trade out. This was the plan we put forth, and it turned into profit for us. So this is just kind of the thought process that we go through and we outline when we try to jump into these earnings trades. And really similar with Snapchat, right? We actually sold, I thought this was hilarious if I could actually learn how to type snap instead of smap. There. Going to that profit tracker, we made $130 on it because we sold a 15 strike put. A 15 strike put, dude. Snapchat is at $38 right now. But at the end of the day on Thursday, right before they announced earnings, they were trading at 24. But we said, hey, let's look at the 180-day. This thing is really fallen off the face of the earth. Peaked to 83.5, went back down to 25. And another trend that I think is very important to pay attention to right here is, what stocks look like this, right? You remember Palantir, you remember Draftkings, you remember Fubo. All three of which are stocks that we are currently playing and trying to catch a little bit of a bounce on. And what you'll notice about this is that when we see a stock like this that has a similar setup where it's been really falling and then has earnings coming up, if there is any semblance of good news, the bounces you could get post-earnings are unbelievable. This was an enormous 50% bounce nearly after earnings on this. So we definitely want to keep that in mind when we're selling covered calls on things like Palantir, things like Draftkings, things like Fubo, because we don't want to limit our upside too much on those and miss a huge similar jump, right? If DraftKings jumped from 25 to 39 overnight and we had our profit capped at 25, I would not be a happy camper. But these are the types of moves that we can see in these types of environments. So definitely a trend that you want to keep an eye on. Keep that kind of move in the back of your mind. But again, heading into earnings, this thing was trading at 25. We knew that we could sell a 15 strike put and get some premium. When was the last time Snapchat traded at 15? The answer is way, way, way back here in the middle of the COVID crash. And, using that idea of support and resistance, it looks like there were a couple points of resistance at that 20 level. So you have, a little bit more of a wall at a higher strike at that 20 level, even though we sold these 15 strike puts. So they should be extra, extra safe. And that is exactly what happened. Those cruised to max profit on Friday for a quick $130 overnight. But again, overall point here is, $130 of profit right there, 95 right there. That's $225 of profit off those earnings trades on research and, some TA that doesn't take that long to do. But again, further point here, right? We know on a week-to-week basis, a lot of the loss that we've had has been coming from Palantir, Affirm, Roblox, Draftkings, Fubo. But we've been getting in and out a lot of these smaller trades too, right? If you look at BKKT down and below, we picked up $2,300 last week. If you look down below these as well, the week before, I think we might have lost money. Yeah, we lost $730 right there. But even in the big week where we lost 23 grand, some of these like Peloton type trades, we picked up $2,500 right there. Even in the week before that when we lost $8,100, you kind of come below the bigger names that we've been playing on a week-to-week basis, and we picked up $1,000 right there. So these losses that we have are paper losses because the trades have not finished yet. We could always make those back. These little gains that we've kind of been pulling at the bottom of the list every single week, these are locked in. These are good to go. This $2,500 that we made at the bottom half of our list for last week, we have that locked in, and we are going to be able to pocket that as profit. So as these Roblox, Palantir, Affirm, DraftKings trades get back to break even, we are going to see a compounding effect with those coming back to break even, in addition to these trades that we already have profit locked in on that we've been crushing on a day-to-day basis throughout the last few weeks. So these definitely are still in play. We got to make these back, but these are locked in. These green numbers are going to stay there. So that's kind of the idea, and that is the end of the recap, which I think it took. We are an hour into the stream, way longer than we typically spend on recaps. However, I did want to spend a little bit longer on that recap because the positions that we have for the upcoming week all come from what we had last week. So in discussing what we like for the upcoming week, we already kind of have in discussing our plan for Palantir, Affirm, Roblox, DraftKings, Fubo, you name it. However, with that said, we're only using 65% of our buying power. We could definitely afford to put a little bit more cash in play. And with how crazy the market has been, right, if we go to this year-to-date summary, with the market going up and down and up and down, volatility is at an all-time high, we've got some decent potential opportunity coming up. Futures are down a little bit, relatively flat, so probably not anything too crazy. But I think game plan for this week is above all else. I think we really, really need to be patient and wait for a red day in the market to enter. Because if we have this laundry list of trades that we take into Monday morning and we enter into those, and on Tuesday the market drops 2%, we are going to be in for a world of hurt. So with this little bit of cash that we still have on the sidelines ready to deploy, we want to make sure that we pick our spots well, because we have seen how quickly things can turn from green to red and red to green and vice versa in these current market conditions. So I can almost guarantee you there is going to be a day next week where you're like, this sucks, I'm losing money. But that same day is where you need to kind of wake up, be alert, and say, okay, even though I'm losing money, I need to recognize that this is a decent entry opportunity into the market, and have a few names in the back of your mind that you might be thinking about entering into. One of those for me is going to be SoFi, if we pull up that chart right here. Maybe following that DraftKings Super Bowl line of logic, the Super Bowl is being played in SoFi Stadium. So, that might be an interesting little nugget right there. But we've got the 3-year chart up here, right? SoFi, former SPAC, so we know there's going to be a little bit of a battleground around that $10-ish level. So I'm perfectly happy to see anything around that 10 level, provided that we could still get a little bit of premium. So this is February 11th. This is the upcoming Friday. At this level, 10, you've got a 1.06% ROR, right? I mean, that is the number that we like to go for on a week-to-week basis, 1% ROR. If you want to get a little bit more aggressive, step it up to 10.5. You lose a little bit of that cushion, but almost double the return. So I could definitely see the merit behind a trade-off in that regard right there. But I do love the idea of getting in on some 10-strike puts when the market drops, right? This thing was up 2.77% on Friday. I think we go to the 5-day chart. Relatively flat since Thursday, but again, you see big candles that are green on Monday, but by Wednesday, some huge red to take it from 13 back down to 11. And if you look back at the past month for this thing trading, I mean, oh my goodness, it ranges from 1647 to 1051. So, point being is I seriously doubt this is a very calm, normal, just a couple percentage points up during the week in a steady line. Very volatile stock, but with that volatility comes some great opportunity for us option sellers. So that's definitely one to have on the in the back of your mind as we head into the upcoming week. Another one I think potentially is Open Door. I hadn't looked at this since Friday at close, but I think it ran up a decent bit on Friday. Yeah, it went up 2.62%. We can get that 1% ROR-ish at 8, right? It's 0.88%, but you can get away with going with 9 because we know even though it's a 9 strike and 9's your max profit level, you're getting about 20 cents of premium here. So that will get you at an 8.80 break-even price. But again, that scares me a little bit because we've seen that this thing could drop all the way down to 8.14. But again, another one, it has had its share of big red candles. So just keep it on the watch list. If you see a big red day on Open Door, that's probably a decent green light to jump in on something in this 8-ish price range for the upcoming expiry. But outside of that, it wasn't a ton that I looked into. So what's the best way to go find some more trade ideas? Let's hit the scanner. And let's start off with our very, very normal. Let's see if I can find it here. Very normal HT without earnings, high ROR puts. And again, if you want all of these option scanners to be imported directly into your Thinkorswim module, just like this, you can pull them up quickly. Hourglass-trader.com. We've got them all on there for our members. So while the results of this load, and I minimize these so we can see them a little bit better. Try to sort these by ROR. There we go. I mean, there's some very, very big time ROR numbers on here. However, what do we know about this ROR scan? The names that are at the top of it typically are not going to be the best from an investment perspective, right? So ANY is like a Bitcoin miner. I know we have some ANY fans that are in our Discord server, but look, this thing was trading at $1.70 back on, what day was this? This was January 25th. This is like 10 days ago. This thing was trading at $1.70. So the idea is, yeah, this is great. You can get a huge amount of premium on 3-strike puts. The thing potentially could go back down to $1.70 just as quickly as it bounced off of $1.70. So would a $2.60 break-even price really be that great? That is where I kind of struggle. And we've got more for in the Twitch chat. Giving a shout out to DWAC, which is always at the top of the of these premium scans right there. And I know More4 is a big DWAC fan, so I don't want to say anything too much, but, let's pull the chart up. I trust that those of you who are following along and watching the stream maybe know a little bit better when we pull up a 1-year chart that looks like this. So without saying too much more about that, I will be staying away from DWAC, but I know More4 has a bullish position, so even though I will not be personally entering myself, I'll definitely be rooting for you, buddy. Back to the scanner, PHUN is kind of a sympathy stock off DWAC. Mara, Bitcoin miner, this is a biotech stock. BBIG, not a good company. Snapchat, we saw that had a huge gap up, meaning there's definitely some potential on the way back down. And again, a lot of the value in this scan is going to come when you actually go to this range that we're happy to sell things in, right? If you start scrolling around in this 2-ish% area, Lululemon on here, that's a decent company. AMD, decent company. You just have to find if there are strikes that you are happy with, right? So let's keep moving through here a little bit. What else can we find? We can see, let's see. Spotify, I mean, we saw that one shown at about 150, so I don't really want to sell a 167 strike put on something like that. Amazon had a big gap up after earnings. Let's see. Let's go. What's going on here? Nothing too crazy. JWN. Wasn't that like Nordstrom or something? I don't know why it's JWN as the ticker. Yeah, it's Nordstrom. We'd played this one before, I think, when it was in the high teens. Yeah, it looks like it's already bounced back off of 19. Can we get in any premium at 19? Nah, it looks like you really only get 1% ROR at 20.5. And another thing here, right? We pull up the JWN, you know, chart right here, and you might say, okay, this thing, 47 RSI. This thing has jumped up a little bit. How do we maybe whittle this scanner down to find some stocks that are a little bit more oversold? And the answer right here is this intersect with feature right here. We can intersect it with a stock scan that we've already built to show some oversold stocks. So if we go to personal, we go to HT oversold. Oversold. Where is it? I don't know if I saved it on here before this. Let me see if any of these make sense. Stock scan, IV change, rank scanner. I don't know, but okay, maybe we could take the approach of saying, okay, maybe not oversold, but what about some stocks that have, DWAC IV is high every single week? What about stocks that have an IV rank, which is really high, indicating that IV is unusually high? So we'd intersect it with the HT IV rank scanner that we've already built out on the Stock Hacker. So you'll see we have 716 results right now. If we run this scan, please work. We're going to end up, there we go, with 33 results. And now we have started to isolate and whittle down that even though we had a ton of results before, maybe not all of them were great. We like to play that IV reversion idea where we think if a stock has unusually high implied volatility, it's kind of destined to come back down. So we could take a look at something maybe like, I don't know, let's look at PDD. I have no idea what PDD is, but I'm sure if we... There we go. We're looking at the 1-year chart. Implied volatility is running up on us a little bit. It's gone from 212 down to 47. I mean, what is this thing? I used to trade down at 18 to I don't know, 30 something a share. So that's definitely a little bit scary because it's kind of on the back end. Another great example of why when we see a setup like this, we stay away from it because this is typically the inevitable back end of, that setup. But I still look at the options, right? There's probably some decent premiums. You can get a 1% ROR at a 50 strike. That is a very, very big cushion. If we take a look at the last maybe 20 trading days, 50 strike, not a bad. I mean, this this thing was at 71 back in on January 20th. So that's a pretty steep drop in that amount of time. But maybe you might look at this one and say, okay, I recognize the stock, and 50 is a good price for me. There you go. We've isolated a stock where IV is unusually high. We've found an opportunity for 1% ROR at a 50 level, which seems to be a decent bit of support. That might be one that you think is a good idea. What else is on here? What MRVL. Let's see what we've got going right there. MRVL is Marvel Technology. If we go to the 1-year chart on that, there you go. Implied volatility unusually high, right? IV rank of 74. So, but there you go, right? This thing used to be trading in the 40-ish. It's a little bit scarier. So, anytime we see downside like this, I like to ignore these trades. But again, it just gives you a little bit more whittled down list of stocks to potentially look at. Like you could sell 66 strike put, but that's still kind of sketchy when you have a bottom candle wick going to 62. Maybe one more really quickly before we get off of this one. Maybe Go EV. I think this is one of those former SPAC EV companies. I mean, this thing has run all the way back down to 5 at the bottom. Can you get any premium on 5? You can get 1.32, it looks like, but that's a pretty wide spread between 4 and 9 cents. So I don't know if you'd really be getting too much there. But again, another good way to whittle down that initial list of high, return on risk stocks is looking at specifically the ones that have really big implied volatility spikes, which is what we've seen right here, and cutting those out of that list that was formerly 700, getting it down to 33. And you could intersect with all sorts of different scans, right? Even though we use the IV rank right there, we can maybe intersect with something like the IV revert. That's not going to have any on it. I used to have an oversold one on here. I will get it back on there and figure it out because that is also a great way to find stocks that are, primed for some sort of a bounce from an RSI perspective, which is always a setup that we like to identify. I mean, a pretty easy way to do that is go to the Stock Hacker. You could add something like, I think you have to go over here and add a study one, and you go to RSI. But for whatever reason, when I'm using dual monitors and I try to add another filter, like my computer crashes. So I will not be doing it live on the stream, but I could do it after I hop off here and maybe share some of the results with you guys. But that's kind of that for the scanner. Let's see what kind of other option hackers scanners do we have right here. Let's clear this intersection out. Let's go back to the main scan. You know, let's see what we can see down in this, 2-ish% range. Tesla, no thank you. Ford, Ford might be an interesting opportunity here. It's run up a ton, and you might say, okay, this is why when you see stocks trading near support levels that are run up so high, this right here is a fantastic example of why it scares me so much. Pretty clear support here at this 19 level. It kept bouncing off of 19 for the last couple months, but now when it gaps below that, and it kind of inevitably is going to fall back down when something's run up like this, where does it stop next? And to me, the answer is maybe 1650 right here, because that's the peak that we saw back in June. So there might be a little bit of a way down right there, but hey, maybe we can sell some near that 1650 level. And the answer, you can actually get 1% ROR at 17, which is a pretty significant cushion on an $18 stock, especially Ford, right? And one of those things where we know that the worst case scenario for our strategy, if a stock continues to move against us, is just that we're left with shares. Getting left with shares of one of the larger car companies in the country is not the worst downside in the world. Now, if you were maybe on a little bit riskier of a stock and you were left with shares of something that had like no revenue, that would be a little bit that'd be a little bit scary. But something like Ford is a solid one, but definitely one since we've identified potential further downside to this 16-ish level. Start with a smaller position, but definitely not a bad idea to maybe jump in on something like that, especially if it moves a little bit further down and we get that entry opportunity in the market that we've been looking for. But again, if we don't get that entry opportunity in the market, right, and S&P 500 keeps going up and the market's green, we're okay with that, right? It's not the worst thing in the world because we already have some long positions that are in play, right? If a firm goes up after earnings and this thing goes down to like 2, that is some very significant profit next week. If Roblox goes up a little bit and we shave a couple more bucks off of those 70 strike puts, that's significant profit. Facebook would probably go down, or if Facebook went up, this would go down a little bit, but not significantly. If the market is green, Draftkings might run back up to 23. Fubo might mess around at the 11 level. And all of a sudden, just off a little bit of green movement here, we found ourselves with a week where we're going to make $17,000. Now, is this me saying we are going to make $17,000 next week? Absolutely not. But the point here is just to illustrate that, one, it's great to be patient for entries, but even if we don't get entries and the market is green next week, it's good because this is potentially what we might be looking at. And again, this gets us a lot closer to break even on the year and that would get us to a position where we are minus 4% on the year. And I can guarantee you SPY is minus, what is it right now? S&P 500 is down 5.5% so far in the year. It is not going to go up 5.5% next week. I can guarantee you that. So I think even though we are underperforming right now, we have set ourselves up in a position to break even on the year before the overall market does. And it's thanks to setups that we're looking at just like this. So what else can we maybe look at from a scan perspective? I think the IV rank one is always an interesting one to pull up. Let's add this scan back in here. IV rank scanner. There you go. This just pulls up IV percentile where it's above 70%, meaning that, it's unusually high. That, of the implied volatility on the stock right now over the past calendar year, it's higher than 70% of the days. And you could even sort these results by IV percentile to say, okay, let's see. Let's show more than 50 here, though. There's 183 results. Let's make sure we get them all on here and then sort them. And there you go. I mean, you have some IV percentiles that are at like 100, right? Chegg right now is through the roof. Uber is really, really high right now, but I think a lot of these have to do with the fact that there are earnings in the upcoming week, right? TTD is 216, meaning that that's not this next week. That's the week after. So maybe the trade desk, we could see that they're TTD. Let's first confirm the suspicion, and there you go. Implied volatility, what this, I guess, in plain English, how to interpret these. When implied volatility percentile is at 100, it means that as of right now, implied volatility on these stocks is higher than it has ever been over the past year. And we can see that modeled down here on the implied volatility line, getting up to 1.06 when it typically trades in like a 0.6-ish level. And that is very, very substantial, right? We see support on the chart here at about 60-ish. I mean, could we get any sort of premium at that 60-ish level? I might need to look at all strikes again. And the answer is, Kind of, to be honest with you, man. I mean, 0.76% ROR is not bad at all. And especially for a stock like this where it would normally take, selling 10 of these would take $60,000. There's only a 10% margin requirement. So there's some very, very attractive investment here from a margin perspective. And, where does my head go to when I see numbers like this adding up? When I see that, it's bouncing off something right now, that implied volatility is at an all-time high. I want to take a look at this 3-year chart and see how low could it potentially go. And there you go, right? This thing used to trade at the 20-ish level, so that would kind of rule it out for what I was trying to get to, which is maybe one of those long-term put-type trades, because when implied volatility is really high, you're probably going to be able to find some decent premium far to the money, right? If we sold what would be a decent-ish level here? I think we can maybe identify some support off the bounces here at the 40 level, so if we wanted to sell a 40-strike put, and we wanted to sell 10 of these and make $1,000, we could do so off 4,000 of collateral. So that'd be a 25% return on capital at the 40 level for TTD. But again, they've got earnings coming up. You'd have to sell the option in that window. I think, maybe a little bit scary for a long-term trade. But again, this is just kind of how you get to a starting point for some of these trade ideas, right? You sort these things, you start reading through the results, you throw a couple of the charts up there. I mean, a firm, there you go. That is our guy right there. We are trying to get a firm to the finish line. You got things like skills, or if you don't see one of these little icons right here, you'll know that they don't have earnings coming up. So SKLZ is one where you might have a really high amount of implied volatility over the last calendar year. There you go. It is through the absolute roof right now. I mean, almost double. Really, it is. It's over double what it was back before Christmas. So you know that means that there's going to be some pretty big premiums on these options. I mean, even a 3-strike put, the numbers look ridiculous, right? When you are selling something for 2 or 3 cents of premium. But from an ROR perspective, it's still a decent amount of money. It's just you might have to fight the commission monster for a little bit of time. But again, even if you wanted to do 350, right? 350 is the all-time low on this stock. And if you wanted to jump in on 3.5 strike puts for the upcoming week, you could get 3.86% of premium on that. That is a fantastic number. With the 50% margin requirement, bumps you up to like a 7% ROC for 1 week. That is phenomenal. And again, how did we find this stock? We went right to our scanner. We sorted this thing by IV percentile, and we started working through the list. And again, when you go to this option hacker and you start intersecting with some of these stock hackers and really cut it down, you can get some very nice focused scans that alert you to some very specific setups and situations. And that's kind of the idea. We're trying to build out a lot more of those for what we've been doing lately in our Discord server, where we have those automated trade idea alerts. And that's kind of the end goal with some of these bots that we've maybe been beginning to set up. But I think those are a few decent ideas. We're about to hit the hour 30 mark on the stream. Again, we had a really, really good week last week, pulling home 14K on the year. But again, similarly to how we said that we weren't worried even during the week where we lost $23,000 and we were down 50K on the year. Similarly to how we were not worried then, we're not, the job is not done just because we had a good week. We're still in the hole. We have a long way to go to get out, but I think we have a very defined path to follow to get out as well. We're just going to keep sticking to some of these decent cushions because there's a lot of volatility in the market right now. And obviously, volatility breeds option premium, and option premium breeds great opportunities for us. So that is what we were excited about. So even though Roblox, Affirm, Palantir, Draftkings might take a little bit longer to reach their finish line than we initially anticipated, the idea is that eventually we will be able to get those to finish line. And in the meantime, these little trades that we're picking up during the week, this is going to add up. If you're picking up $2,000 a week on these little add-ons, that's absolutely going to add up. 10 weeks of that will make this back regardless of what happens here if these don't go any higher for us. But again, we have a defined plan. We are always going to stick to the process, trust the process, and trust that 2021, even though we took home 110%, and that's not going to happen this year, I'll be the first to tell you. But this type of these consistent gains with the way that we kind of tweaked our strategy a bit July going forward, this type of stuff is repeatable. It is consistent, and we are going to stick with it. We're not going to let a couple of shaky weeks knock us off of our game. So thank you for those of you who have tuned in, who have been following us, and hopefully y'all continue to follow us as we dig ourselves out of the hole. This has been the Hourglass Trader, where as time passes, we make money. Signing off for the night, and hopefully we see you again same time next week. Actually, I take that back. I'll jump ahead of the train on that one. We are not doing the same time next week because the Super Bowl is next week, and hopefully we're going to be sitting here with all of our Draftkings money just, raining down from the sky. But I think tentative plan for next Sunday is going to be streaming at noon or like 1 o'clock Eastern, something like that. So we're all done by the Super Bowl, and you don't have to be the weirdo watching me talk about the stock market while the Super Bowl is going on. So that is the plan for next week. Thank you guys for following us for another week. And again, hopefully to see you next week. Thank you so much for those who continue to stick with us. And we are going to get it back to even. It has been a tough 2022 for sure. But again, this transparency, I think, is so important. Just as much as we show off the $14,000 weeks, it's so important to talk through the 23K losses in a week or the 8K losses in the weeks that preceded that, because that is just the reality of trading. You're not going to go in a straight line to the top. And, in hopefully April, May, June, July, things like that, we could look back at this and laugh and, use that experience to look back on it. It just makes us better traders. And, experience is probably the single best teacher. It's one of those things where I think the saying is that the most expensive lessons are sometimes the best lessons. And unfortunately, there is a lot of truth to that. But once we get out of this tunnel, once we get out of the hole, we could look back at this hopefully with some, some fond memories, because we will be looking at it from a place of profit. But these are the types of stretches you go through the market that make you a much, much better trader. So we're going to keep pushing through this. Can't wait to talk about it next week. We're going to be on the Discord every single day this week, and we are in it with you guys. We are in this together as a team, and hopefully our team is going to come out on top in the end. So thanks again to those of you who have stuck with us for this hour and a half stream. Let's do it again next week. See you guys.